I'd like to introduce Sarah Goldhart and John Petzinger to start today's webinar.
All right, thanks, Demetra. Appreciate it. And thanks everybody for joining us today. This is always one of our favorite sessions of the year, one that we do every December, where we're going to take a look back at the year in review that was 2025 and look ahead to 2026 and some of the trends. As Demetra mentioned, I'm Sarah Goldhart, State and Local Tax Partner here at GBQ, joined today by my colleague, John Petzinger, our Senior Manager in our SALT group. And we're excited to walk you through some of the trends and updates that we're seeing in the state and local income tax area. Today's agenda for our webinar, we're going to cover a lot of different topics. Usually with this session, I know we have a mix of participants on the call that are maybe at a C Corp, that work with pass-through entities, maybe have companies, work at companies that are multi-state, some that maybe are just in Ohio, which anymore there's not many companies that are solely in Ohio. It seems like most at least have one or two other states with activity. But we try to cover a lot of different things, and even a few individual updates, for those kind of looking for their own updates for their personal income taxes as well. So we're going to cover a lot of different things, some emerging multi-state income tax trends. I know not everybody on the call is multi-state, but I think it's important to look at some of the trends across the country, high level of what we're seeing, just to give you an idea of the flavor of what's going on in multi-state income tax. We're going to talk about some of the state tax impacts of the One Big Beautiful Bill Act that was passed earlier this year on July 4th. That was a big piece of federal legislation, but now there's a lot of state impacts that we'll be seeing from that federal bill. John will be covering some developments in the elective pass-through entity taxes. This is something we've been talking about since the Tax Cuts and Jobs Act back a few years ago. So we'll talk about developments there. I'm going to cover some sales sourcing updates for revenue sourcing for apportionment and some apportionment opportunities, things to think about there from a planning perspective. Key takeaways from Ohio's biennial budget bill. This was a budget bill year in Ohio, so John's going to talk about that, a little bit of a recap of what was in the bill and what's at the Ohio legislature currently, things that we're watching as we head into the new year. And then we'll be covering some few notable cases, some income tax cases and some Ohio CAT cases. CAT continues to be an area that impacts a lot of our clients. And, while there's been some changes to the CAT, maybe there's not as many taxpayers subject to it anymore. There's still a lot going on in the CAT space. So we'll be covering that as well. Just some general notes about our presentation. Just take a look at those. And we'll get started. Before I actually dive into some material, let's do our first polling question number 1, and our word is apportionment. So I think we're going to run that. So if everybody can give you a few seconds to get that entered. Okay. All right, a couple more seconds. All right, and we'll go ahead and get started. So I'm going to start today with some multi-state income tax trends. And again, these are some of the kind of high-level topics and updates and things that we're seeing from a lot of the different states over the past year, and things that we feel, folks, business owners should be aware of, things that are going on across the country. The first one is Internal Revenue Code conformity and adjustments to the tax base. So conformity itself really isn't maybe a trend. It's something that a lot of the states have to do every year. So if you're familiar with IRC conformity, the states all conform to the Internal Revenue Code, to the federal Internal Revenue Code in different ways. There's really 2 main ways. One is called rolling conformity, where a state will just automatically conform to any changes that happen to the IRC. some states have what's called a static or a fixed date conformity provision, and that means that, their conformity is only through a very specific date. And because of that, if there's changes to the federal code, they have to update that date periodically to match the Internal Revenue Code. So, this is something that happens regularly every year, but why I would call it a trend for this year is because of the One Big Beautiful Bill Act, which I would say the OB3A Act that was passed in July 4th of 2025. We're going to see a lot of activity. We have already, but really going into the 26 legislative sessions, we're going to see a lot of states put out guidance in this area. For those that have had rolling conformity and maybe already include then the OBBBA in their within their statutes, we're going to see them probably decouple from certain provisions of the bill. That means that they're going to say, hey, we're going to conform to the federal IRC, but there's certain provisions in there that we're not going to follow. And I'm going to talk a little bit about those later in the presentation. For those that are fixed date or static date conformity, we're going to see them, first of all, update the conformity, that date to include probably the OBBBA. And then they'll decide also if they're going to follow some of the provisions or also decouple. So there's going to be a lot of activity in this space, a lot to sort through. Way too much to get into in detail in this webinar, but just understand that that's something, if you follow state tax updates, you're going to see a lot around conformity and decoupling from provisions, and because of the OBBBA and all of the provisions within that. So that's something that you'll just, again, see a lot of, especially as we head into early 2026, when a lot of the states come back to start their legislative sessions for 26. As far as some specific updates around conformity, I've noted a few on this slide. Just that I thought were noteworthy. Again, there's a lot of updates in this space, and I'm not going to go through all of them, but a couple interesting ones was Virginia. Virginia a few years ago actually switched to a rolling conformity, which means they all just automatically conform. But because of the OB3 bill, they've decided that they're going to pause that for a couple of years, and that's really because of some of those provisions, which I'll talk a little bit about later. But just an interesting approach from Virginia to say, hey, we're gonna pause this because we really want to take a look at all of these provisions in this bill and be able to react to certain ones. For California, this was pretty noteworthy. California, and I know we have a lot of clients that do business in California. I always say I think we probably spend, even though we're sitting here in Ohio, probably 30% of our time on California matters. California actually updated its conformity to 1/1/25. That's for corporate and individual income tax purposes. And that was their first update in a decade. So that was one that was, you pretty much have known for the past 10 years, if there was federal legislation, because they hadn't updated their code, you knew that it was not applicable to California. Now they've updated it. However, even though they have done so, they still are going to continue to decouple from still some of the provisions from the Tax Cuts and Jobs Act and then from the OB3 bill. So a lot to digest there in California, as always, but just very noteworthy there as far as its conformity. And then to highlight a couple of the border states, to Ohio, Michigan, and Pennsylvania, they've already come out with some guidance. They've updated Michigan updated its conformity date, but again, likewise with Pennsylvania, they're decoupling from several of the OB3 provisions, which I'll talk about those main provisions here in a few minutes. But so again, a lot going on in this area that we'll continue to see into the new year. Another trend, this is one that we talked about last year. We were looking back at some of the trends from December of 24, and we continue to see some rate reductions. Now, that's not to say there haven't been some states that have increased rates at all or have tweaked their rates or maybe planning to increase. But for the most part, some of the trend that we've seen is a reduction in both the corporate rates, and I've got a few examples there in Georgia, Utah, even Philadelphia, if we're looking at the local level. And then on the personal income tax side, New York tweaks some of its rates in some of the brackets, and then Ohio, which was newsworthy this summer, and John's going to talk more about that later in the webinar. One of the other interesting notes, if you follow state income taxes, this last bullet, is that we've seen a good number of states transition to a flat income tax rate, a state rate, which is something I think that always comes up at the federal level. You always, every few years, hear people say, hey, are we going to go to a flat rate at the federal level? But at the state rate, it is something that we've seen come to fruition. And I thought there's an interesting article from the Tax Foundation where they called this the flat tax revolution because in the first 100 years of state income tax, there were only 4 states that had transitioned from graduated rates to a flat income tax. But just between 2021 and 2025 alone, we've seen 8 states move to transition to a flat income tax rate. So what's driving that? Simplicity is the big thing. I think that's why it tends to come up at the federal level too. There's that idea that it's simpler, it's easier for everybody to understand. Transparency, when you're doing planning, whether it's on the individual side or really for the states as well, if it's a flat rate, it's kind of easier math. And so, in this time period when the states are all trying to find a way to be more competitive, to give some favorable treatment to their residents, maybe prohibit some residents from moving to no tax states like Texas and Florida. They're trying to do things to kind of, again, make things simpler, lower rates for the residents, be more transparent. So we've got the 8 states listed here on the slide. And again, Ohio is on there, which John will cover, but just some this is very noteworthy if you follow state income tax. And from a planning perspective, it does add some simplicity when trying to kind of estimate tax liabilities and kind of just the total understanding of the income tax. Another area where we're seeing it's kind of newsworthy and a lot of activity is around economic nexus and Public Law 86272. This is also one that we've talked about over the past few years. If you're not familiar with Public Law 86272, it is a federal law that's been in place since I think the 1950s that prohibits a state from imposing income tax on a business who its only activity in the state is the solicitation of orders of tangible personal property. And so, this has been a topic of conversation for years. Back in 2021, the Multistate Tax Commission put out a statement of where it basically listed out some of the activities that are considered protected or not protected under 86272. And that really kind of opened up again the debate on what's a protected versus unprotected activity in a state that can create income tax nexus. There's been a lot of talk around activities that involve the internet. When 86272 was written, there was no internet. It's still a very kind of old school rule. And so they've been trying to update it more to include some of the activities that are, part of our daily lives now around the internet, with being able to reach out to customers via the internet, having a chat on website, internet cookies, things like that. So we've really seen more activity and some litigation in this area. Earlier this year, there was HR 427, the bill at the federal level that was introduced in January of 2025, which would have expanded the protections of 86272. It was going to redefine what the solicitation of orders meant, and again, really expand the protections, which I think a lot of business owners looked at as very favorable. That bill ultimately got rolled into the OB3 bill and passed the House. It was in the House version, but it was not in the Senate version or the final version of the bill. And again, it would have broadened the protections of 86272. So it was not in there. But we continue to see a lot of activity in this space at the state level. We'll continue to monitor if there's any federal movement to try to add some kind of uniformity around these activities and what's protected or not. But I've highlighted a few state updates because a few of the states have adopted some of the MTC guidance from a few years ago into their provisions. Again, kind of making that, increasing the list of unprotected activities, especially in the internet space. Massachusetts was one this year that revised its interpretation and its code around 86272, and specifically around the use of internet cookies, meaning if your company kind of leaves a cookie behind on a customer's computer to be able to do research, it's placed on the computer to do research, that now is considered for Massachusetts purposes an unprotected activity. This whole idea of the internet cookies has been interesting from our perspective as tax professionals trying to give guidance in this area. A lot of times when we do nexus reviews for our clients and have to dig into this, this whole idea of the website chat and the internet cookies is not something that usually the folks that we're talking to, maybe the controllers or the VP of tax directors, et cetera, really even know much about. And so it really results in having to talk to folks in IT, maybe the company's IT department, and really dig in and get an understanding of what, how the website works and how the cookies work and things like that. So it's really added a level of complexity in trying to determine nexus. Arkansas adopted a bright line economic nexus threshold starting for 2026. So this means that even if a company does not have a physical presence in the state of Arkansas beginning in 26, if they have sales that trip that $250,000 threshold, they are presumed to have they have nexus in the state. So we've talked over the years about other states that have added this bright line, similar to kind of Wayfair on the sales use tax side, on the income tax side, kind of that same idea where if your sales exceed a number, it causes nexus. So that's something if you've got activity in Arkansas to watch out for starting next year. And then a couple of cases I've highlighted in New York and Oregon. The American Catalog Mailers Association, that's a trade association that's been trying to help its members fight the MTC guidance that I just mentioned in terms of 86272. That's ongoing legislation in New York, or litigation in New York. What New York was trying to do was not only incorporate the MTC guidance on 86272 into its code, but make it retroactive back to 2015, which at this point is 10 years ago. In the latest ruling, the Catalog Association was successful in having New York saying, or the court saying the rules could not be retroactive to 2015, that was excessive. But they did agree that New York could adopt the guidance of the MTC and kind of restrict 86272. So that's one that we continue to watch. And then an interesting case out of Oregon, actually there was two. There's the NBC Universal. There was also a similar case with Time Warner. This is around nexus, again, that economic nexus, where the court ruled that because NBC Universal gets ad revenue through its affiliates, even in the state of Oregon, even though it itself doesn't have physical presence, that it resulted in that the company that NBC Universal does have nexus in the state of Oregon. So the states are really trying to chip away at nexus and find ways to tax companies that may not have a physical presence, an office, an employee, a plant, things like that, really trying to chip away and figure out how they can tax companies without that presence. Another trend, state apportionment. This is one we've also talked about over the years, and so we've included it because it just continues on. The single sales factor apportionment. So if you're a multi-state company and have to calculate apportionment to divide up kind of your taxable income, I always refer to it as kind of the pie, and using apportionment to figure out kind of how much each state can tax through apportionment. Over the years, a good number of states now have moved to what's called single sales factor apportionment, where you just take the sales into that state divided by sales everywhere, and that's the percentage. So we have a couple more moving to that, Arkansas in 26 and Kansas in 2027. The other trend we've seen is market-based sourcing for sales of services and other sales other than tangible personal property. Market-based sourcing means the sales are sourced to the location of the customer, kind of where the benefit of the service is received. You know, the majority of the states now use market-based sourcing as opposed to cost of performance, where the service is performed. Again, Arkansas and Kansas moving to the methodology in 26 and 27. Alaska, interestingly, was going to be moving to two similar methodologies, but the governor vetoed that bill here recently. We expect Alaska to revisit that in early 2026. Revisiting some of the state tax impacts of the OBBBA. You know, I really talked earlier about conformity and decoupling, and you know, again, this is something we're going to be watching over the coming months, how each state is going to conform to the updates or some of the provisions of the OB3. I mentioned decoupling from provisions. There's really 3 provisions of the OB3 that most of the states are decoupling from at this point, and that's the bonus depreciation going back to 100%. You know, this is one, there's a lot of states already that do not conform to bonus depreciation, so that may not be surprising. But there have been a couple states, I think like Pennsylvania, that has flip-flopped a couple times on bonus, treatment of bonus. So it's definitely something that you're, you know, adding back, you know, 100% of depreciation can definitely cause, you know, a difference in your state tax liability versus that favorable federal treatment. So it's something to consider for planning going forward. The treatment of R&D expenditures, this has been a hot topic over the past few years, having to add back the R&D and now deducting. Again, this is favorable at the federal level, but the states are all looking at it. All 3 of these, again, in the business interest expense, the 163J, again, favorable for federal. And that's really why the states are looking at these 3. They're favorable, but, you know, from a state revenue perspective, the states are, you know, trying to analyze the impact of these 3 provisions and kind of the loss of revenue that they would experience if they allowed these provisions to go through. So, so I would expect we'll see more states publish guidance that will decouple from these 3 provisions going forward. So you really have to check each state's rules, their conformity date, and then each state's rules on these provisions when you're doing your state tax planning. I do get a lot of questions on conformity. We're really covering just the business side of things today, but from a conformity on the individual side, the question I'm getting the most is around state conformity to the new tips and overtime deductions of the OB3 bill. That's an individual level deduction. You know, on that one, we're still seeing guidance come out on that. But a lot of the states start their individual income tax calculations with AGI. Those deductions are after, from AGI. So in a lot of states, those deductions really don't even factor into the calculation of the individual income tax. If they do, if the state starts with taxable income, then it is something that you have to take a look at. Now, there outside of that, there are some states that are proposing their own deductions for tips and overtime. Ohio is one of them, and John will be talking about that. But that's probably the biggest question. And again, you really have to look at each state and how they're going to be, how they calculate the tax, what the starting point is, and then how they, if they're going to have their own deductions for those items. I'm going to turn it over to John now, who's going to talk about developments in pass-through entity taxes. John.
Thanks, Sarah. So elective pass-through entity taxes, just to give a little background here, we've discussed these taxes the last several years on our SALT updates. The Tax Cuts and Jobs Act 2017, federal law, capped the state and local tax deduction for itemizers to $10,000. So in response to that, a number of states sought ways to help their residents get around that limit. In particular, some of these efforts started with higher tax states. So where it ultimately landed was that states have enacted these taxes that, for business owners at least, they can get around the $10,000 limit by having tax imposed at the pass-through entity level rather than at the individual level, and then the states allow credit for those taxes. So these tax regimes tend to be neutral for state income tax purposes, but allow business owners to qualify for effectively a larger state and local tax deduction on their federal returns. The IRS blessed these arrangements, these statutory schemes back in 2020, and over the course of really like 2018 to 2022, most states with a personal income tax adopted a version of a pass-through entity tax. There's, at this point, I think 5 states with a personal income tax that don't have a pass-through entity tax. The biggest one of note is Pennsylvania. And there's been proposals and there's been discussion for Pennsylvania to enact one of those, but they really haven't gotten very far. And after this many years, it kind of seems unlikely that that will happen. Turning to Ohio specifically, there was a provision in the budget bill that was helpful for tiered pass-through entities. So prior to this change, there was no crediting mechanism for tiered pass-through entities making a pass-through entity tax election. Now, the Department of Taxation had, they'd done a good job of allowing tiered pass-through entities to pass credits through like holding companies that maybe wouldn't have had a reason to file PTET returns. But in situations where there were tiered pass-throughs that maybe each had their own Ohio income that could be subject to the tax, this budget bill provision allows that crediting to happen, so to avoid sort of duplicative payments and associated cash flow issues with that arrangement. So the change that was made allows pass-throughs to claim credits on the IT 4738 for lower tier pass-throughs that have also paid tax on the IT 4738. It applies to 2025 forward, so current year, and looking into 2026 as well. Moving on to the next slide. We've been saying kind of since day one on these elective pass-through entity taxes, similar to a lot of other issues in SALT, that every state does things a little bit differently. And it's always important to study the details and make sure that you know that just because the tax works one way in one state, it may not be the same in others. So some things to keep in mind currently with the PTETs. Some states, so I guess backing up, the cap in the TCJA of $10,000 was set to expire, and I'll get to OBB be in a minute here as to what's happened. But some states that elected or that enacted the elective PTETs tied their PTET regime to that time frame from TCJA. For example, Minnesota, currently their PTET is scheduled to expire and wouldn't be available in 26. There's some other states in that same bucket. So something to look out for as we go into 2026. There may be some activity in this area to extend those taxes. And in fact, California is one that's already done that. I'll go to the last bullet here first. So in speaking of the details of these programs, states generally have been pretty responsive to concerns raised by taxpayers and places like the state bar associations or state CPA groups to help make these taxes as friendly and as seamless as possible. Again, with the backdrop that, again, for state purposes, it really shouldn't be a cost to the state. It's really facilitating this federal deduction. So as you look at planning for 2025 and 2026, know that in states where rates have decreased, Sarah mentioned a little while ago the sort of continuing trend of both corporate and individual income tax decreases. The pass-through taxes tend to follow suit, as well they should. There's also been some favorable changes in a few states to the mechanics of making the election, whether that's timing or how the election is actually submitted. Many states allow the election to be made simply by checking a box on the partnership or S corp return. Alabama was one where until recently a separate form had to be submitted, and it had to be submitted online through Alabama's tax portal. That's been updated, so it's a more it's easier and less of a trap for missing that election. Michigan also changed the timing. They were a state where the election had to be made kind of upfront by March 15th of the taxable year for a calendar year taxpayer, but they've since updated that to allow the election to be made after the year with the return being filed. So that's good. As part of One Big Beautiful Bill Act this summer, I'm sure those of you who were watching that closely, there was a lot of discussion about the SALT cap. That was kind of a thorn in the side of a number of legislators, particularly from California and New York, which has higher tax rates and presumably has more of its residents affected by the SALT cap than maybe lower tax states or states with no taxes. So the negotiated resolution of that was an adjustment to that $10,000 cap. And the new SALT cap is set at $40,000. And the changes are made effective for 2025. So the cap moved up to $40,000, but there is a phase down of that when taxpayers' income goes above $500,000, and the SALT cap is reduced by 30% of the amount by which income exceeds $500,000. So in effect, a taxpayer with income of $600,000, so $100,000 over 30% of that, $40,000 minus $30,000, the TCJA limit is back in effect once income exceeds $600,000. That $500,000 floor is increased by 1% each year for the next 5 years. Importantly, the SALT cap was made permanent, but it's set to roll back to 10,000 beginning after 2029. So the SALT cap has been bumped up temporarily, so we may be looking again at this issue here in a few years. As part of the OBBB, during that process, at one point, I think the U.S. House had passed, as part of their bill, a provision that would have restricted pass-through entity tax benefits for specified service businesses. So in particular, looking at like accountants, lawyers, doctors, it would have disallowed the flow-through benefit of the PTET deductions for folks in those professions. That ultimately didn't make it into the final bill. So at the end of the day, with this new SALT cap, question is, are PTET elections still beneficial for business owners that have been maybe taking advantage of that for the last couple of years? And the answer is yes. The OBBB did not impose a SALT cap on calculation of income for partnerships or S corps, nor did it include any sort of limit on those deductions as they pass through to the individual owners. So the Fed tax benefit of the PTET elections is still in place. Now, based on the increased SALT cap, there may be business owners who might not need to make a PTET election to get those savings. For example, if their income is below 500,000 and their taxes are not, their total SALT deduction wouldn't be more than $40,000. So there's for folks that maybe fall in that range or close to that range, there's some modeling that can be done and to help decide whether the PTET election is beneficial or not. But there shouldn't be, for folks with distributive shares going well above that or AGI going well above that, the pass-through entity taxes still provide that Fed tax savings that's been central to these regimes since they were put in the last few years. And going to the next slide, we have our next polling question, which is Nexus. So go ahead and get that input. We'll give you a little bit of time here.
We don't even answer a question this year. Just get the word in. Just get the word in. Okay. All right. Thank you, John. I'm going to just talk for a minute before John talks about Ohio specifically, about a little bit more about apportionment. I mentioned some of the trends earlier, the move to single sales factor apportionment, the move to market-based sourcing for sales of services and sales other than sales of tangible personal property. I can't stress enough, if you're a multi-state taxpayer, how important this area is, and really taking a look at it and digging into how you're sourcing the sales. And with the change from states going to single sales factor, there's just a lot of complexity in this area. There's some, with complexity can come errors, but also there's, some room for planning and just a review of your sourcing methodology, making sure you're being compliant, but also really getting an understanding of, in particular, if you sell services, how that sale works, where's the customer, the benefit of the service, the market for that service. There's a lot that can go into determining where to source a sale, and then how to calculate the apportionment factor. There are still states, there still are a few remaining that use a 3-factor apportionment based on property, payroll, and sales, which for a long time was the way that most states determined apportionment. But because of advancements in technology, they've moved to that single sales, because you really don't even need a physical location, property or employees sprinkled around the country anymore, or physically in a plant or an office. So that was what was really driving that change. And again, we've also seen the move, I mentioned, to market-based sourcing. That was from cost of performance sourcing, where people were actually doing the work. So there's definitely nuances there that can definitely have a significant impact on your apportionment factor in a state, and then ultimately how much tax the company is paying. I always like to note there's still a few states that have different apportionment rules too for partnerships versus the corporate rules. So you also have to watch out for those few states as well, because that can make a very big difference depending on what type of entity you are. A couple of additional cases I just have noted, or additional guidance that I wanted to point out. California put out some significant guidance earlier this year, just back in October, at the beginning of October. They updated their market-based sales sourcing regulations for 26 and forward. If you're a service provider filing in California or doing business in California, maybe you're not filing yet, you're definitely going to want to take note of some of these changes, especially if you're a professional service provider, or again, just another service provider doing business in California. If you were already familiar with California's market-based sourcing rules, they were already complex. There was layers and layers of tests and kind of that waterfall testing to get to an answer. So now there's even more guidance. So I would say if you're again a service provider, or outside of selling tangible personal property in California, it's something you're going to want to take a look at. Massachusetts, this was one where it's noteworthy because there are some states, and I've got this noted kind of in the last bullet too, that have specific apportionment methodologies for different types of businesses that are industry-based apportionment methods. There was a case out of Massachusetts where a company was found to be a manufacturer, so they were required to use single sales factor in Massachusetts, as opposed to the normal three-factor apportionment, which will be changing in Massachusetts. But again, a noteworthy case there. There's the states have different methodologies, again, and I've noted some of the industry types there. The manufacturers in a few states do get impacted by that, having to use single sales. There's a couple that have service providers. I think Arizona had one that if you're a service provider, you use a different methodology. But there are states that have different methods for transportation companies, financial institutions, sports franchises. So if your company falls into kind of one of those areas, you really need to take a closer look at the apportionment guidance in the states. Again, there could be planning opportunities there. So just with all of the focus on apportionment and some of those trends and changes, it's really a good time to dig into your apportionment for, again, some planning and also being compliant. Our third polling question is depreciation. So go ahead and get that one entered. CPE polling question number 3, depreciation. Okay. All right, everybody got that one in? All right, I'm going to turn it back over to John, who's going to kind of wrap things up here over the last 15 minutes on Ohio budget bill, what came out of that bill, and what's going on in the legislature currently. John?
So 2025 being an odd year, it was an Ohio budget bill year. And one of the big changes that we saw in the legislature here was with respect to income tax rates. So for 2025, the top rate was reduced down to 3 1/8, 3.125%. And then in 2026, Ohio is joining that flat tax revolution that Sarah mentioned and going to 275 on all income above the minimum threshold, 26,000. Interestingly, the business income tax rate is going to remain at 3.0 under current law, which is obviously 3.0 is greater than 275. So it kind of flips that tax rate where, in prior years prior to this change, the business income rate was preferential, in addition to the business income tax deduction being allowed, which that doesn't change. So if you do the math on this, it's about $3 million is when the incentive changes to call income non-business as opposed to business. But we're talking about 0.25% here, so it's not a huge difference. So, relative to, when business income rates and deduction were first put in place, sort of the incentive or the benefit of that is shrinking down here right now. Next slide. we got a duplicate slide. We'll go to the next one. There are a few other changes in the budget bill relative to income taxes. The annual inflation indexing for the brackets was frozen for 25, obviously, because of the changes that were made. And then also the indexing of exemption amounts for 25 and 26 were frozen as well. So we got reductions of rates, which provide tax savings, but a little bit of that is kind of clawed back here through these adjustments. Also, for taxpayers with modified AGI exceeding 750 for this year or 500 going forward, personal, spousal, and dependent exemptions are disallowed, as well as the joint filing credit. So again, a little bit of a clawback to those rate reductions, but that's what they put in there. A few other changes. The school district income tax on estates was repealed beginning in 2026. Under current law, a school district with traditional tax base taxes estates. So for school district income taxes, there's two bases on which the tax may be imposed, depending on the particular school district. It's either a traditional tax base, which is going to be your modified AGI, which would include certain types of retirement income, or what's called an earned income tax base, which is, maybe similar to a muni tax base, where you're looking at traditional wages and earned income, as opposed to passively passively generated income. There's approximately, I think it's about 210 or so school districts in Ohio that have an income tax, and the split is traditional is the majority. Traditional is about 150 of the 210, and the rest are earned income. So this particular change here, if there's an estate in one of the 150 traditional income school district income tax districts, this is a helpful change. Next up, there was a modification to conform the muni income tax net profits return extensions for those who do not have a federal extension to conform it to those that do. So that extension is now 7 months. So for a calendar year taxpayer, the extended due date is now November 15th. There was a change to the statute of limitations for refund claims to make it 3 years after the later of either the date of overpayment or the date the return was due, including any extensions. If there were some oddball situations where a person's refund claim would not be married up with a city's ability to audit and assess tax. And so I guess in an effort to kind of marry those two up so that we're on equal plane here between taxpayers and cities, this change kind of clarifies that. And so if you have a potential refund or client has a refund, you may want to just double check these changes so you understand what the new limit statute of limitations may be there. And next slide. So there's been tax legislation introduced not only this past year prior to the budget, but there's been some recent introductions as well. Kind of gives a sense of what issues may remain out there or what may be upcoming for legislative action. The first two here deals with overtime wages. Interestingly, the overtime deduction proposal was for state income, whereas the tip exemption proposal would have applied for state, school district, and muni income tax. Those have been introduced. There hasn't really been much action on them. As Sarah mentioned, with Ohio not piggybacking taxable income, but piggybacking AGI, those federal changes don't carry over. And so there may be discussion of whether that is something that Ohio would like to adopt. We'll have to wait and see. Same thing with federal bonus depreciation. That was discussed as part of the budget process. As we've mentioned before on these updates, the state's decoupling from bonus depreciation is really an issue of timing, accelerating those deductions, allowing companies to see immediate benefit from those investments. The problem, if you will, from a state perspective, and specifically Ohio budgeting perspective, is that Ohio operates on 2-year budgets. So while in a 5 or 6 year sense, it's just a matter of timing, for Ohio budgetary purposes, to go to allowing full bonus depreciation would be a revenue negative adjustment for the budget. So that makes it a little more difficult to conform to that. More recently, there was a bill introduced to create a refundable credit for hiring certain veterans and their spouses. There was also a recent House bill introduced that would exempt all capital gains from state and municipal income tax. Of course, capital gains are generally already exempt from muni income tax, but this would clarify, or it would include maybe if there's any kind of situation out there where maybe the capital gain gets pulled in, that would not be the case here. So next slide.
I would say that federal bonus bill is the one that we probably get asked about the most. I think everyone's kind of clamoring to make that easier from a compliance perspective and not have to track it, the state federal difference. But so I know a lot of people have their eyes on that bill in particular.
A couple other pieces of legislation, not related directly to income tax, but earlier this fall, there was a lot of legislative activity and state activity around the regulation and taxation of intoxicating hemp products. If you recall, Governor DeWine wanted to pause that and put some guardrails around the sale of those products. The legislature's got a bill that has a number of regulatory provisions in there. And one of the things that is in the bill as well is a 10% gross receipts tax that would be imposed on licensed hemp dispensaries. So we'll see where that ends up, but that's something that to be aware of if you or your clients are related to that industry. There's also a Senate bill out there that would increase the sports gaming tax from 20% to 36%. This is imposed on the sports gaming tax operators. So think of your, the folks that advertise on TV and the apps and so forth that receive this revenue. Ohio's tax rate of 20% kind of sits in the middle. There's some states up in the Northeast that are as high as 51% tax on those receipts. And then there's other states that are below 10%. So, rates are kind of all over the board. Not all that surprising. It's kind of a new industry and new tax regimes. Illinois and Pennsylvania, closer states to Ohio, those are higher rates, whereas like Indiana and West Virginia, those are below 10%. So we're kind of sitting right there in the middle here in Ohio. One other piece of legislation I wanted to highlight, which was recently introduced, House Bill 613 would reform tax appeal procedures before the Ohio Department of Taxation and to some degree at the Board of Tax Appeals as well. Again, it's just been introduced, but something to be aware of. If you've had appeals, and this would apply to all types of taxes, whether it's commercial activity tax, sales tax, income tax, et cetera. If you've had the opportunity to have an appeal go through the department's administrative procedures, it can take a long time. There's no set time frame or deadlines. So this bill would shrink that, put some guardrails around the process, allow for some automatic appeals, formalize settlement processes. Around the Board of Tax Appeals specifically, would require the board to issue a decision within 1 year after a hearing is held. So again, it's just been introduced now, but something to keep your eye on, particularly if you've been active in this process in the past. Next slide, please. There are a few cases out there to keep an eye on. I know we're wrapping up here in a few minutes, but 2 cases to highlight at the Ohio Supreme Court are both commercial activity tax cases. Straub Nissan case, which the tax commissioner appealed about a year ago, deals with a Nissan dealership sitting just outside Ohio. The Department of Taxation audited them and assessed commercial activity tax relating to sales to customers who come from Ohio over the border, purchase a car, and then take it back to Ohio. There's been other cases over the years around this what's so-called ultimate destination rule for sourcing sales of tangible personal property. So this will be an interesting one to watch. The taxpayer actually prevailed at the Board of Tax Appeals here. The board, to paraphrase, basically said there's not really delivery here at any place other than the dealership where the customer takes possession. Another case just very recently appealed by the tax commissioner is this Perigo case, and this deals with certain chargebacks between a manufacturer of pharmaceutical products and wholesaler based on price adjustments related to retail prices from the retailers, your CVS, Walgreens, et cetera. And the issue there is whether those subsequent price adjustments are a price adjustment, as the taxpayer contends and as the BTA held, or whether they're more akin to an expense or a deduction and therefore taxable, or a return or allowance, that sort of analysis. And the bigger picture on this case is what is a gross receipt? In this case, there's an invoice which both parties know is not the ultimate price that's going to be paid. So this will be an interesting one to watch. Next slide, please. There's some other issues to watch, cases percolating between the department's final determinations and the Board of Tax Appeals. Relative to business income tax, recall just recently, in the last couple of years, there was a change to the definition of business income to include gains or losses from a partial or complete liquidation, including gain or sale from disposition of goodwill or the sale of an equity or ownership interest in a business, provided that the sale is treated as a sale of assets or the seller materially participated. The department's taken a position in some cases that the status of a business as a C corporation disqualifies the owner's gain from business income treatment. So that's an interesting one to watch. Determination of a high residency, business, non-business, those continue to be issues. We've mentioned on prior calls as well, credit for qualified research expenses, the CAT R&D credit, that's been a subject of heavy auditing the last couple of years. And then similar to the Perigo case, there's at least one other appeal, perhaps more, dealing with sort of, what are gross receipts for CAD purposes. Hopefully get some guidance relative to how that's determined, whether it's with reference to federal income tax authorities, GAAP authorities, or what that may mean. So good stuff to look out for, and we await decisions.
All right, I think we're right at time, and we have our last CPE polling question. So it's appeals. So go ahead and enter that, appeals. Okay, a few more seconds. All right. Well, thank you, everyone. I think that's the end of our content, and I know we're right at time. So I think there was a question or a couple questions in the chat. We'll follow up directly on those. But thank you, everybody, for joining us today. We appreciate it. If you have any questions about anything that you've heard here today, feel free to reach out to myself or John. Our contact information is, I believe, in the slides here. Is in the slides. So feel free to reach out. And again, we appreciate it and hope everybody has a good holiday season. All right. Thank you.